This is Nicole, and in today's video, I want to focus on S&P 500 seasonality, what the data says about Q4 and November. This video is for educational purposes only and not investment advice. So what is seasonality? Seasonality in the S&P 500 is a well-documented phenomenon showing persistent calendar-driven patterns in stock performance throughout the year. Historically, certain months exhibit tendencies towards strength or weakness driven by a mix of fiscal factors, investor behavior, and fund flows. The S&P 500 typically performs best from November through April, with particularly strong returns often observed in November, December, March, April, and July. November is especially notable for its average outperformance, often exceeding a 2% return historically. Taking a look at the data over the last 30 years, we can see that November has performed the strongest of all the months, coming in with a return at 1.78% on average. In recent years, correlations between current price action and historical seasonality are extremely high, over 90% for the 5 and 7-year averages, emphasizing persistence of these cycles. So let's bring up some more recent data for SPY, the S&P 500 ETF, by looking at seasonal returns in bar chart. When we bring up the data, we can see that this data set represents 2024 through 2010 for the fourth quarter, because we are not through 2025 data as of yet. And when we take a look at the month of November, we can see that it outperforms significantly, coming in with an average return of 3.28% for the month. I'm just going to highlight the data there. So you can take a look at the November returns through the course of 2024 to 2010. And when I scroll down, we can see that the month has finished positive 80% of the time and has come in negative 13.33% of the time. So when you average the data from 2010 through 2024, the pattern is clear. The fourth quarter, October through December, shows the strongest performance of the year. October comes in at a positive 2.23% on average. November has a positive 3.28% on average, and December shows a positive 0.75% on average. When you compare that to September, which has a negative average of 0.52%, the shift from September to November often marks a transition from volatility to recovery. And it's interesting to note that the average monthly return for the S&P 500, excluding dividends, is about 0.61%. So why does November stand out? Historically, it's positive about 80% of the time, with an average return above 3% in recent years. November has the highest win rate of any month in this data set, and the reasons make sense. Earnings season winds down and uncertainty fades. Fund managers rebalance before year-end, with many looking at trying to catch up to their benchmarks, and consumer spending wraps up. And finally, market psychology tends to turn optimistic heading into the holidays. Even in a volatile year like 2022, November still came in positive at 5.56%. So of course, seasonality isn't a trading signal, but it is context. Seasonality is not absolute. Macro policy, news events, and other shocks can override these tendencies, and the key is risk management. Remember that 20% of Novembers were in the red in recent history. So as we head into November, the odds tilt bullish, but probabilities are not guarantees. Keep your analysis sharp, manage size, and remember, markets don't owe us seasonality, they just tend to rhyme with history. These patterns are useful for both risk management and for identifying higher probability tactical opportunities, especially when combined with broader market analysis. If you found this video interesting or helpful, please like, share, and subscribe. And as always, be awesome. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy, and review your financial situation, risk tolerance, costs, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions can change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.